There is a number that the casino industry does not advertise and that no marketing campaign has ever featured and that you will never see on a billboard on the Las Vegas Strip or in a television commercial or in any of the promotional materials that the Nevada Gaming Control Board approves for public distribution. The number is $10 billion. $10 billion is the estimated annual amount that Americans lose to gambling debt, not the money they lose gambling, which is a separate and much larger number, but the money they borrow to gamble, lose, and then cannot repay. $10 billion in loans taken out against houses, in credit cards run to their limits, in casino ATM vestibules, in personal loans from banks and payday lenders and family members, in retirement accounts liquidated before the penalty age, in college funds emptied over a weekend in a hotel room with the curtains closed. $10 billion that was owed before it was lost, that carries interest while it is being lost, and that must be repaid after it is gone. $10 billion that the industry that generated it does not discuss in its responsible gambling materials, does not acknowledge in its shareholder presentations, and does not factor into the resort fee calculation or the 6-to-5 blackjack payout or any of the other financial engineering decisions that have made the modern casino floor the most efficient wealth extraction mechanism in the history of American consumer finance. This video is about how the casino debt trap works, not in the abstract. In the specific, documented, step-by-step mechanical detail of exactly how a person who sits down at a slot machine or a blackjack table with money they can afford to lose ends up, months or years later, owing money they cannot afford to repay to institutions that were specifically designed to ensure that outcome. It is about the systems the casino industry has built, the credit mechanisms it has deployed, the psychological architecture of the floor that makes debt feel like a solution rather than a problem, and the specific points in the spiral where a person could have gotten out but didn't because the environment they were in was engineered to make getting out the harder choice. It is about the people this happens to, who are not the people the gambling industry's responsible gambling materials describe. They are not exclusively addicts in the clinical sense, though some of them are. They are ordinary people who encountered an extraordinary system designed to defeat ordinary human psychology, and they lost. The casino debt trap begins not at the moment the debt is incurred, but at the moment the architecture of the casino floor is first encountered. Because the trap is not primarily a financial mechanism, it is primarily a psychological one, and the financial debt is the material residue of a psychological process that has already run its course by the time the credit card comes out. The floor is designed to create a specific cognitive state in the person moving through it, a state that researchers in the psychology of gambling describe as the zone or the flow state, and that casino designers describe in their internal documentation, which has been produced in litigation and obtained through public records requests as continuous gaming productivity. The zone is a dissociative state. It is a state of narrowed attention in which the person's awareness contracts to the immediate sensory experience of the game, the screen, the cards, the sound of the machine, the physical sensation of the bet, and the anticipation of the outcome. In the zone, time does not pass in the normal way. External obligations do not press with normal urgency. The internal signals that ordinarily regulate behavior, hunger, fatigue, financial anxiety, social responsibility, are suppressed by the sustained stimulation of the gaming environment. The zone is real. It is measurable in the brain activity of people experiencing it, and the casino floor is designed from the carpet to the ceiling to create it and sustain it. The specific design elements that produce the zone have been documented in academic literature on casino design and in the testimony of casino architects and interior designers in various litigation proceedings. The absence of clocks and windows eliminates the environmental cues that regulate temporal awareness. The layered, continuous audio environment of the slot floor, which consists of thousands of individual machine sounds designed in specific frequency ranges that activate the brain's reward circuitry, creates a sonic landscape that sustains attention and suppresses the impulse to leave. The lighting, which is calibrated to eliminate shadows and create a uniform, slightly elevated brightness that does not correspond to any natural lighting condition, produces an environment that the brain cannot easily characterize as late or early or time to go. The layout, which deliberately creates a non-Euclidean navigation experience in which exits are difficult to locate and the path from any game to the exit requires passing additional games, ensures that the decision to leave requires sustained intention rather than casual impulse. All of this is design, none of it is accidental, and all of it is deployed in service of one outcome: keeping the person at the machine or the table past the point at which they intended to be there, past the point at which their budget has been exhausted, and past the point at which the decision to access additional funds feels like a rational response to the situation. The casino credit mechanism is the bridge between the psychological trap and the financial one, and it is a mechanism that the industry has refined over decades to be as frictionless as possible at precisely the moment when friction would be most protective for the player. The ATM in the casino is not placed at the entrance, where a person arriving with a clear head might use it to withdraw their gambling budget and proceed with intention. It is placed on the floor, often adjacent to the highest volume gaming areas, accessible without leaving the gaming environment, and surrounded by the same sensory architecture that produced the zone in the first place. A person who walks to a casino ATM has typically already lost the money they came with. They are in an altered cognitive state. They are experiencing the specific emotional condition that gambling researchers call chasing, the compulsive pursuit of losses through continued play that feels, in the moment, like a logical response to the mathematical situation, but that is in fact a well-documented cognitive distortion produced by the neurological effects of sustained gambling on the brain's reward system. They are not making a financial decision in the normal sense. They are executing a behavior that the environment has produced in them, and the ATM is the material instrument of that behavior. The casino ATM charges fees that are dramatically higher than standard ATM fees. A typical casino ATM fee runs between $5 and $10 per transaction, compared to the $2 to $3 fee of a standard bank ATM. On a cash advance from a credit card, which is the instrument of choice for the person who has already emptied their checking account, the fee is a percentage of the transaction amount, typically between 3 and 5%, in addition to the ATM surcharge and in addition to the cash advance fee charged by the credit card issuer, and in addition to the interest rate on the cash advance balance, which typically begins accruing immediately at a rate between 24 and 29% annually with no grace period. A person who takes a $500 cash advance from a credit card at a casino ATM pays the casino's ATM surcharge, the credit card issuer's cash advance fee of approximately $15 to $25, and then begins accruing interest at 25% annually on the balance from the moment the transaction is processed. The $500 they use to continue gambling costs them money before it ever reaches the felt. And the felt, as we have established in previous videos in this series, has been engineered to ensure that the $500 joins the money that came before it. The casino credit line is the more serious mechanism, the one that produces the truly catastrophic debt outcomes, and it is a product that exists in a regulatory space that is unique to the casino industry and that would not be tolerated in any other consumer lending context. Casinos offer credit lines, called markers in industry terminology, to players who apply for them. A marker is a line of credit extended by the casino directly, without the involvement of a bank or any other regulated lending institution, to a player who wants to be able to play beyond the cash they have on hand. The application process involves a credit check and a review of the applicant's banking history, and the approved credit line can range from a few $1,000s to several $1 million for high net worth applicants. The casino issues markers from this credit line on demand, on the floor, at the table, with no cooling off period and no additional underwriting review at the time of issuance. A player who has a $50,000 marker line approved can draw against it at any point during a session by signing a document that the casino issues at the table, and the $50,000 is available immediately in the form of chips. The marker is legally a check. In Nevada, a marker is treated as a negotiable instrument, and failing to repay a marker within the required period, which is typically 30 days, is treated as a criminal offense under Nevada Revised Statute 205.13, which criminalizes passing bad checks. The casino that extends you a marker and that you cannot repay can refer your case to the Clark County District Attorney's Office for criminal prosecution. You can be prosecuted, arrested, extradited from your home state, tried, and convicted of a felony for failing to repay a casino marker. This is not a theoretical legal mechanism. It is actively used. The Clark County District Attorney's Office has a dedicated unit that prosecutes marker cases on behalf of casino creditors. Prominent people, including athletes and entertainers, have been prosecuted under this statute. The casino debt is not like a credit card debt or a personal loan debt, where failure to repay produces adverse credit consequences and collection calls. It is a debt whose non-repayment can put you in handcuffs. The psychological context in which markers are issued makes their legal weight particularly significant. A player who is issued a $50,000 marker at 2 in the morning in a casino where they have been sitting for 8 hours is not making a credit decision in the same cognitive state as a person applying for a car loan. At a bank branch on a Tuesday morning, they are in an altered state. They are chasing losses. They are in the specific, documented, neurologically compromised condition that sustained gambling in a designed environment produces. And the casino, which has been in the business of producing that state for decades, is extending them credit at the exact moment their decision-making capacity is most impaired. The casino's credit manager who issues the marker has access to the player's history, knows how long they have been playing, knows what they have already lost, and issues the credit anyway. Because the marker is only profitable for the casino if the player continues gambling with it, and the player who is in a state of loss chasing at 2 in the morning will continue gambling with it. The casino knows this. The marker is issued because the casino knows this. The debt spiral that follows a marker issuance has a remarkably consistent structure across the thousands of documented cases that gambling addiction researchers, bankruptcy attorneys, and financial counselors have compiled. The marker is drawn, the gambling continues, and the marker is lost. The player returns home with a debt obligation to the casino that they may or may not have disclosed to their spouse or partner. They have 30 days to repay the marker before the casino presents it for payment. If they cannot repay it within 30 days, which is the situation for the significant majority of marker holders who are gambling with money they do not have, they are typically offered a payment arrangement, a series of installments that extends the repayment period and accrues interest. The payment arrangement creates a sustained financial obligation that must be serviced from the player's ongoing income, which reduces the disposable income available for other purposes and creates financial pressure that, in the documented psychology of problem gambling, frequently drives additional gambling as a coping mechanism and as a perceived solution. The person under financial pressure from the casino debt is being drawn back to the casino by the specific psychological mechanism that produced the debt in the first place. The debt is the symptom and the cause simultaneously. The demographic profile of casino debt victims is the thing that the gambling industry's responsible gambling materials most consistently distort, and the distortion is deliberate because the accurate demographic profile is commercially inconvenient. The industry's messaging about problem gambling focuses heavily on a clinical addiction model, on the idea that problem gamblers are a small, identifiable subset of the population with a specific neurological vulnerability that distinguishes them from ordinary players. This framing serves the industry's interest because it contains the moral problem within a clinical category. If problem gamblers are a specific type of person with a specific brain condition, then the casino is not responsible for the outcomes they experience in the same way that a bar is not responsible for the outcomes experienced by an alcoholic. The casino is providing a legal product. A specific subset of users has a disease that makes them unable to use it safely. The casino is not the cause of the disease. The actual demographic data compiled from bankruptcy filings, debt counseling case studies, addiction treatment intake records, and credit bureau data tells a different story. The people who accumulate devastating casino debt are not predominantly clinically diagnosed problem gamblers. They are predominantly ordinary middle-class Americans who experienced a specific set of circumstances that intersected with the casino environment's design at a vulnerable moment. They are people going through divorces, people who have recently retired and lost the structure of a working life, people who have experienced a significant financial loss and are attempting to recover it, people who have been prescribed medications that have gambling as a documented side effect, people who encountered the casino environment for the first time during a period of grief or anxiety or isolation and found that the zone provided temporary relief from psychological pain. None of these people are sick in the clinical sense that the casino industry's framing requires. They are ordinary people who encountered an extraordinary system during a moment of vulnerability. And the system was designed to exploit vulnerability with the precision of 40 years of research into exactly which design choices produce exactly which behavioral outcomes. The prescription medication angle deserves specific attention because it is the most recently documented and the most aggressively suppressed component of the casino debt story. Dopamine agonist medications, which are prescribed for Parkinson's disease, restless leg syndrome, and certain other conditions, carry a documented side effect of impulse control disorders, including pathological gambling. Multiple studies and extensive case documentation in legal proceedings have established that a significant percentage of patients prescribed dopamine agonist medications develop sudden onset problem gambling behaviors that are entirely absent from their pre-medication history and resolve when the medication is discontinued or adjusted. These patients are not problem gamblers in the genetic or psychological sense. They are pharmacologically induced high-risk gamblers who are sitting in an environment that was designed to exploit high-risk gambling behavior. The class action litigation against the manufacturers of these medications has produced settlements in multiple countries and has generated extensive documentation of the mechanism. The casino industry's responsible gambling programs do not screen for dopamine agonist medication use. The casino floor does not post warnings for patients taking these medications. The casino's player relationship management system does not flag an account holder who has recently started gambling heavily after years of moderate play and who might benefit from a conversation about whether a medication change could account for the behavioral shift. The house edge and the debt trap interact in a way that is mathematically elegant and morally devastating. A player who enters the casino with money they can afford to lose, gambles within their budget, and leaves when the budget is exhausted has experienced the house edge as a consumer paying a price for entertainment. The edge took their money at a known rate, and they received the entertainment of the gambling experience in exchange. That transaction, while imperfect and arguably manipulative in its design elements, is the transaction the industry describes in its marketing. The player who enters the casino with money they can afford to lose, loses it, and then draws on credit to continue, is experiencing a qualitatively different transaction. The house edge is now being applied to borrowed money. The cost of the entertainment is now the cost of the debt, plus the interest on the debt, plus the psychological and relational cost of carrying a secret financial obligation, plus the ongoing financial pressure that the debt servicing creates. The entertainment value of the original session, whatever it was, is being paid for over months or years at an effective interest rate that makes the casino's house edge look trivial by comparison. The velocity of loss in the modern casino environment, which several previous videos in this series have addressed in the context of rule changes and game design, accelerates the debt trap in a specific and underappreciated way. A player who loses their $500 budget at a 3-2 blackjack table with favorable rules and a 0.5% house edge is experiencing a slow, manageable loss that produces a session of significant duration. The mathematical expectation of losing $500 at the correct rate of loss produces hours of play. A player who loses their $500 budget at a 6-5 blackjack table with a higher minimum bet and multiple unfavorable rules is experiencing a faster loss rate that produces a session of shorter duration. And the shorter session produces the specific cognitive experience of having lost too fast, of not having had enough time, of the loss feeling wrong rather than natural. That experience of the loss feeling wrong is a significant trigger for chasing behavior. The industry's rule changes over the last 15 years, which have increased house edges and minimum bet sizes across the strip, have simultaneously increased the velocity of loss and therefore increased the frequency with which ordinary players reach the emotional state that produces chasing behavior and credit access. The game changes made in the name of margin improvement are also, incidentally and predictably, debt trap accelerants. The regulatory landscape that governs casino lending and debt collection is the final component of this story and the one that most clearly reveals the deliberate policy choices that have allowed the trap to exist at this scale. Nevada's marker statute, which criminalizes non-repayment of casino credit, has no equivalent in any other consumer lending context. A bank that extends you a personal loan and that you fail to repay cannot have you criminally prosecuted for the failure. They can sue you in civil court, obtain a judgment, garnish your wages, and damage your credit. They cannot refer you to a district attorney for criminal charges. The casino can. This asymmetry in legal consequence is not a neutral feature of Nevada law. It is the product of casino industry lobbying that has maintained the marker statute against every reform effort. Because the criminal enforcement backstop is the mechanism that makes high-value marker lending viable as a business product. Without the criminal enforcement backstop, high-risk players would default on markers at a rate that would make the credit product unprofitable. With the criminal enforcement backstop, the player who draws a $50,000 marker faces consequences for non-repayment that are severe enough to ensure collection rates that justify the lending. The law is a debt collection mechanism dressed as a fraud prevention statute. The federal regulatory gap is equally deliberate. The casino industry successfully lobbied for exemptions from several consumer financial protection regulations that would otherwise apply to their credit products. The marker is not subject to the Truth in Lending Act disclosure requirements that apply to consumer credit products, which means the casino is not required to disclose the annual percentage rate of the credit it is extending or the total cost of the credit over its expected repayment period in the standardized format that bank lenders are required to use. The Casino Currency and Monetary Transactions reporting requirements of the Bank Secrecy Act apply to certain large transactions but are structured in ways that the casino industry has successfully advocated to make as minimally burdensome as possible. The responsible gambling programs that Nevada casinos are required to maintain are self-regulated, self-reported, and not subject to independent auditing of their effectiveness. The industry defines the adequacy of its own harm reduction measures, assesses its own compliance, and reports its own outcomes to a regulator whose funding comes from the taxes on the industry it regulates. The path out of casino debt is narrow and poorly lit because every institution with the capacity to illuminate it has an interest in keeping it dark. The casino has an interest in keeping the debt obligation in place because the criminal enforcement mechanism gives it collection leverage that no other creditor possesses. The credit card companies have an interest in keeping the balance active because the cash advance interest rate is among the highest in their portfolio. The casino-adjacent financial services companies that offer gambling-specific personal loans and lines of credit at effective interest rates that rival payday lending have an obvious interest in the borrower continuing to service the debt rather than discharging it. Bankruptcy is available for casino debt in most circumstances because casino markers are treated as unsecured credit obligations in bankruptcy proceedings in most states despite their criminal enforcement in Nevada, but the bankruptcy process requires legal representation that carries its own cost and that the person in the debt spiral frequently cannot access. The National Council on Problem Gambling maintains a helpline that connects callers with treatment resources, but treatment resources for gambling disorder are dramatically underfunded compared to treatment resources for substance use disorders, which is itself a reflection of the policy environment that the casino industry's lobbying has produced. The one structural protection that exists and that the industry works hardest to make obscure is the voluntary self-exclusion program. Every Nevada casino and most casinos in jurisdictions with legal gambling offer a mechanism by which a person can voluntarily place themselves on an exclusion list that prohibits the casino from allowing them to gamble on their premises. In Nevada, the voluntary exclusion list is maintained by the Gaming Control Board, and enrollment in the list prohibits a person from the gaming floor of every licensed Nevada casino for a period of their choosing, with options that include 1 year, 5 years, and lifetime. A person on the exclusion list who enters a casino can be escorted out by security, and if they win while gambling, their winnings are forfeited. The self-exclusion program is imperfectly administered. Casinos have been documented allowing excluded players to gamble without enforcement of the exclusion. The program does not extend across state lines, except through voluntary compacts between participating jurisdictions. And the program requires the person seeking exclusion to identify themselves at a gaming control board office in person, which creates a procedural barrier that is particularly high for people in the acute phase of problem gambling, when the barrier to seeking help is already significant. But for the person who has reached the recognition that the casino environment is not one they can safely participate in, self-exclusion is a real, available, and legally enforceable protective mechanism. It exists, it can be used. The casino industry does not advertise it. The most important thing to understand about the casino debt trap is the thing that the industry's responsible gambling messaging is designed to prevent you from understanding. The trap is not a failure of individual willpower or a manifestation of individual pathology. It is the intended output of a system. The casino floor design that produces the zone is not the unintended consequence of commercially motivated decisions about lighting and layout. It is the product of deliberate research into the psychology of sustained play, deployed with full knowledge of the behavioral outcomes it produces. The marker credit mechanism that makes $50,000 available at 2 in the morning to a person who has been losing for 8 hours is not a neutral financial service. It is a product designed for a specific customer at a specific moment, and the specific moment is the moment when the customer's decision-making capacity is most impaired and their gambling behavior is most likely to produce revenue for the house. The regulatory exemptions that allow the criminal enforcement of casino debt and the non-disclosure of credit costs are not neutral policy outcomes. They are the results of sustained, well-funded lobbying by an industry that understands exactly what its credit products do to the people who use them and has concluded that the revenue generated by those products is worth maintaining the legal architecture that makes them possible. If you are in casino debt, the first thing to know is that the shame the system is designed to make you feel is a product of the system. It is not a reflection of your character or your intelligence or your worth. You encountered a system built by the most sophisticated behavioral scientists and casino designers in the world, operating with decades of refinement, and it did what it was designed to do. The second thing to know is that the debt is addressable. It does not feel addressable from inside the spiral. Nothing feels addressable from inside the spiral. But the National Council on Problem Gambling Helpline, which is 1-800-522-4700, connects to people who have seen this specific situation and know the specific path through it. The third thing to know is that the casinos that are owed the money you cannot repay are very large companies with very large legal departments and very large lobbying operations, and they have specifically shaped the laws to make collecting from you as easy as possible. You need someone on your side who knows those laws as well as the casino does. A bankruptcy attorney in your state, specifically one with experience in gambling debt, is that person. Most offer free initial consultations. The consultation costs nothing. The debt costs everything. Make the call first. The casino debt trap ruins thousands of lives every year, not because those lives are weak or those people are foolish. Because the trap was built by people who are very good at building traps, who have been building this specific trap for 40 years, and who have made sure that the laws and the regulations and the social stigma all work together to keep the people inside it from getting out. The only way the trap changes is if enough people understand exactly how it works. Now you do.